Welcome to vTalkInsight, Allocator's Lens Daily for March 16, 2026. Cross-asset conditions are being reshaped by a historic oil supply shock, a repricing to higher-for-longer interest rates, and a powerful surge in the dollar, all against a backdrop of growing stagflation risk. Today we will connect how that mix is filtering through equities, bonds, credit, currencies, and commodities so allocators can gauge where portfolio risk is actually building. In equities, the dominant story is how a severe energy shock and a jump in rates are colliding with already stretched valuations. The main United States index is on track for a third consecutive week of losses, and volatility gauges are holding in the high 20s. Yet the damage is highly uneven beneath the surface. Large growth and technology names are taking the brunt of the adjustment. Information technology has been the weakest sector. The megacap growth basket has slipped into correction territory, and high-profile software names like Adobe have seen outsized drawdowns as investors reassess artificial intelligence disruption and slower recurring revenue growth. At the same time, there is a clear rotation in flows and performance toward what might be called real economy and defensive exposure. Exchange-traded fund data show money moving out of technology vehicles and into energy, industrials, and materials. While on the index level, utilities and consumer staples have started to outperform as risk appetite fades. However, that rotation is not without tension. Energy stocks have already run hard and now look technically overbought, while parts of the consumer complex, especially packaged food and household brands, face rising input and logistics costs but limited pricing power, squeezing margins just as consumer sentiment and job growth soften. This mix looks uncomfortably close to a stagflation backdrop, which historically has been challenging for broad equity benchmarks and kinder to value and cash-generative businesses. Commentary now stresses the importance of robust balance sheets and durable cash flows, as speculative and narrative-driven names have become far more vulnerable in an environment of higher discount rates and volatile demand. Yet index-level declines remain contained for now because sector dispersion is so high, and that creates a latent risk. If correlations were to spike, whether because of an escalation in the Middle East or a hawkish surprise from the Federal Reserve, risk managers already urging deleveraging could accelerate selling and turn a slow grind into a sharper correction. Upcoming earnings from consumer and technology bellwethers, together with the next Fed decision, therefore sit as key catalysts for whether this remains an orderly rotation or becomes a broader equity drawdown, and that naturally leads us into the rates picture. Rates markets have swung decisively back toward a higher-for-longer narrative as the oil shock bleeds into inflation data. United States core personal consumption expenditures inflation rose 0.4% month over month and 3.1% year over year, broadly in line with expectations, but still well above the Federal Reserve's target. And several commentators now argue inflation may hover closer to 3% through 2026. Against that backdrop, traders have pushed out expectations for rate cuts, with some pricing scenarios that see no easing through 2026 and even a potential hike further out. While 2-year Treasury yields have jumped around 35 basis points this month, and 10-year yields sit near 4.3% after one of the largest recent sell-offs. The repricing is not just a United States story. In Europe and the United Kingdom, central banks face a sharper dilemma as energy-driven inflation collides with already weak growth and fiscal strains. Markets have moved from expecting European central bank cuts to now discounting more than one hike by year-end as headline inflation could re-accelerate toward 3% if the Middle East conflict persists. While in United Kingdom's stagnant gross domestic product, rising defense and energy spending, and persistent deficits are adding pressure on gilt yields and raising questions about long-term debt sustainability. Volatility across sovereign curves has surged to its highest in around 9 months, reflecting not only macro uncertainty, but also foreselling as some investors liquidate front-end positions to meet liquidity needs elsewhere, including in stressed private credit vehicles. This environment complicates the traditional role of government bonds as a portfolio hedge, since inflation and fiscal worries are pushing yields higher, even as growth risks build. The main counterpoint comes from those highlighting a significant productivity boom in the United States, with multi-year gains above 3% seen as a potential cushion that could eventually give the Fed room to ease if inflation cooperates. For now, Though upcoming core PCE releases and the next Fed communication are pivotal for whether this latest repricing in rates stabilizes or spills further into risk assets and credit conditions. Credit markets present a split screen between a still orderly public investment-grade universe and growing strains in private credit, and that divide matters for how financial stress might propagate. On the public side, high-grade issuance has been very strong, led by large technology companies raising funds for capital expenditure. And the overall quality mix of the investment-grade index has improved, with more AA and less BBB- exposure than in recent years. Heavy issuance from the tech sector has pushed spreads in that pocket wider relative to the broader market, suggesting that supply and demand are moving closer to balance. But there are few signs yet of a broad base seizing up in primary markets. In contrast, private credit vehicles, especially those sold into retail channels, are experiencing mounting redemption pressures and liquidity concerns. Several funds have imposed withdrawal limits, and commentary likens the dynamic in some segments to a slow-motion run, with investors seeking cash as equity markets weaken and headlines around software exposure and opaque structures proliferate. Major banks have meaningful but manageable exposures, and some are reconsidering how aggressively they distribute these products to non-institutional clients, while analysts emphasize that banks are less leveraged than before the global financial crisis and that the bulk of the risk now sits outside the traditional banking system. European banks add another layer of complexity, facing short-selling pressure and questions about private credit holdings, artificial intelligence disruption to business models, and macro shocks from the Middle East conflict, all of which are weighing on regional equity indices. So far, the stress appears largely contained within specific private credit strategies rather than spilling over into broad investment-grade spreads. But the linkages are visible, including through episodes of forced selling in short-dated treasuries to raise liquidity. For allocators, that means monitoring redemption trends, bank funding conditions, and any shift in public spread behavior remains as important as tracking the macro data itself before turning to the currency dimension. Foreign exchange markets are amplifying the story coming from rates and commodities, with the United States dollar reasserting itself as the primary safe haven. The dollar index has climbed to its strongest levels since last May, supported by higher relative yields, delayed expectations for Fed easing, and demand for liquidity as geopolitical risk rises. The euro has dropped to its weakest point against the dollar since August, reflecting both policy divergence and mounting stagflation fears in the euro area, while the yen has slid toward the high 150s, creating fresh challenges for policymakers in Tokyo and adding pressure on other funding and carry trades. This move has been particularly painful because it runs against the grain of popular positioning from earlier in the year, when many portfolios were tilted toward a weaker dollar and overweight Asia. The sharp rise in front and United States yields and the stronger dollar have forced some investors to unwind those trades quickly, contributing to liquidations and a broader risk-off tone that also weighs on emerging market currencies, especially in energy importing economies now facing the double hit of expensive oil priced in an even stronger dollar. How long this phase of dollar dominance persists will depend heavily on the path of Middle East tensions and the evolution of inflation and rate expectations, but it is already reshaping relative performance across both equity and bond markets. Commodities, and oil in particular, remain at the center of the macro regime shift. The effective closure of the Strait of Hormuz has taken an estimated 6.7 million barrels per day offline, the largest disruption the oil market has ever seen, pushing Brent well above $100 and at times toward $120 per barrel, with prices up roughly 30 to 40% this month and around 10% just in the past week. Shipping through the Gulf has largely stalled, with thousands of vessels stranded or rerouted and exports from Asia to Gulf states almost halted, while bunker fuel, insurance, and war risk premia have roughly doubled freight and fuel costs along key routes. What worries many observers is not just the current level of prices, but the potential duration and second-round effects. Estimates suggest that if the disruption were to persist for several months and remove close to a fifth of global supply, crude could plausibly test the mid-$100 range or beyond, especially given that offsetting sources such as Venezuelan output and strategic stock releases are too small or too slow to fill a gap of that size. There is also the risk that damage to fields and infrastructure leaves capacity impaired even after a ceasefire, making a quick return to pre-conflict price levels unlikely. While some officials argue the economic impact could still prove relatively short-lived for energy-resilient economies like the United States. Beyond oil, the shock is rippling through other commodity markets and supply chains. European natural gas prices are up about 70% this year, sharpening the focus on energy security and accelerating investment plans in both renewables and gas infrastructure. Aluminum prices are expected to stay elevated amid regional disruptions, and shortages of inputs like helium are already pushing up semiconductor costs, with particular vulnerability in countries such as Taiwan. Higher energy, freight, and fertilizer costs are feeding into food and consumer goods pricing, even as weak volumes limit how much companies can pass on, raising the prospect of sustained margin pressure alongside stubborn headline inflation. If oil and related prices stay high long enough, history suggests demand destruction will eventually emerge as a counterweight, but until then, commodities remain the fulcrum for the entire cross-asset outlook. Stepping back, the cross-asset picture is now dominated by an energy shock that is driving stagflation risk higher, forcing a higher-for-longer reset in rates, boosting the dollar, and exposing fault lines in parts of the credit complex. Equities are adjusting through sector rotation and rising dispersion rather than outright capitulation, while government bonds offer less diversification than usual as inflation and fiscal concerns keep yields elevated. Public investment-grade credit still looks resilient, but private credit and some European banks bear watching closely, and currency moves are amplifying the strain on energy-importing economies. For allocators, the key variables over the coming days are the duration of the Strait of Hormuz disruption, the trajectory of core inflation data, and any sign that equity correlations or funding stresses are starting to rise in tandem across markets. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.